QuickBooks Online 2025, analyzing the statement of cash flows. Get ready and some coffee because we're learning how to save time with QuickBooks Online 2025. Here we are online in our browser, searching for that QuickBooks Online test drive, the free sample company file available to everybody, looking for the result that has Intuit.com in the URL because Intuit is the owner of QuickBooks. We're going to be choosing the United States version of the software, and then we have to verify that we're not a robot. But still, I feel like the robots are smart enough to check that thing off, man. I don't think this is a safe space for humans anymore. This is not a safe space. I don't feel like. The robots have invaded every area. I can't go nowhere these days, man. It ain't right. Anyways, we're in the sample company file. We're in the Craig's Design and Landscaping Services. We're going to be opening up the reports. Let's go to the reports on the left-hand side. In the standard tab, we're going to go into the favorites, right-clicking on that balance sheet to open a link in a new tab. Right-clicking on the profit and loss, opening a link in a new tab. Go into the middle tab, closing the hamburger and changing the range to the 2-year time frame as has been our custom. 010124 tab 123125. Selecting the drop down in years, running it so we have 24 and 25 side by side. Let's tab to the right side, closing up the hamburger, and then we're gonna do it again. Otra vez. 010124 tab 123125 tab. Drop down. We want to see it in years. Run it to refresh it once again, noting that these two reports, balance sheet, income statement, those are the major financial statement reports, but there is another financial statement report that typically is presented at the same time with external reporting, that being the statement of cash flows. However, I do want to think of it as basically a little bit different than these two main reports. Why? Because these two main reports are basically, if you think about how they are constructed as we do the data input. In other words, if I go to the plus button, let's go to the plus button here. Whenever we enter these forms are the data input forms that are used to generate the journal entries for all of the normal type of transactions that happen in essence on a day-to-day basis. We can think of them as recording according to the double entry accounting system, the debits and credits, or in accordance with at least two accounts impacted for the accounting equation, assets equal liabilities plus equity. And those then are used to create, we can think of as in essence a trial balance. And the trial balance is basically then used to create the profit and loss and balance sheet. So these reports are being generated directly from the data input. And that's why we can bounce over here and look at the impact directly every time we do a data input into the system. We enter a form. But the profit and loss is kind of a step removed. In other words, the statement of cash flows will be somewhat of a step removed, meaning if you think about the order of operations, we do the balance sheet, income statement, and then use those to create the statement of cash flows. Now, quick recap before we even go into the statement of cash flows. Why do we need it? Well, note that this income statement is the performance statement. It's showing the activity, what we have done over a time frame, measuring, and the analogy being like if we're driving a car and we want to see how far we're going to go in a day, we can reset the odometer and then see how far we're going to go. Income statement, we're seeing how much revenue and expenses we generate as we go through a month of activities, a quarter of activities, a year of activities, for example. However, the way we measure income and the way we measure expenses are when we incur the income and when we incur the expense, meaning when we actually did the work on an accrual basis is when we record the income, and when we actually incur the expense, when we consumed goods and services for the purpose of generating income, is when we record then the expenses. That's the accrual method. You might say, hey, look, I might not be on the accrual method. You might not be. You might have a more simplified system, such as a gig worker, for example, recording everything through the bank feeds, in which case you could still basically say you're on an accrual system, but you can also say you're on a cash system. The two systems, in essence, are the same under those circumstances because there's no timing difference between when you incurred the revenue and when you got paid, and when you incurred the expenses as to when you paid out the expenses. It's only when there is a timing difference, such as when you have to invoice the client, track accounts receivable, or enter a bill into the system and track accounts payable, that there will be a difference between an accrual basis and a cash-based type system. So if this is on an accrual-based system, the reason that's important is because the net income should be reporting performance that is comparable so that we can try to judge how well we did and hopefully improve. And that becomes a problem on a cash-based system for certain types of transactions. The most common example, or the one that's easiest to see, is like if we were to purchase a building for cash that cost, $100,000, and we just simply expensed it because we paid cash for it on a cash-based system, then that would mean, like, if I compare January to February, January would have over $100,000 loss in it because we bought the building. And February would look like it's not impacted at all by the building. But in actuality, of course, the building was bought as an asset. It should be on the books as an asset and then basically depreciated, the cost being allocated over the time frame that we use it, for example. That's the idea of the accrual system. And even if you're on a cash-based system, you typically, when buying a building, would do that automatically and or would be forced to do that by, like, the tax code, if nothing else, if you're in the United States. So, but we would still like to see a cash flow system on top of the accrual system. So how could we do that? Well, we can add another report. We get the best of both worlds. We see the income statement on a performance statement, on an accrual statement, and we then recreate, in essence, the income statement mainly, although we're going to have two other components to it as well, on a cash-based system, so that we get the best of both worlds. That's kind of the idea of it. All right, so how do we get to this to the report? Let's go to the first tab. Let's go down to the reports on the left-hand side, and within the business overview, we should have our statement of cash flows. Here it is, statement of cash flows. We will right-click on that and open a link in a new tab. I'm going to go to the tab to the right. I'm going to try to explain this one in more detail. This is going to be more of just kind of a theory idea rather than a data input thing for QuickBooks, because many people just simply don't understand the statement of cash flows that well. And it's obviously one of the three main reports, so it's useful to know about. There's also some different kind of constructions on where you can construct the report, so we should have some idea about that as well. Noting that for small businesses, you might not spend as much time on the statement of cash flows because you, for example, might just simply be trying to be in compliance, possibly if you're in the United States, with tax compliance, which means at the end of the year, what do you need? You need, at the minimum, a profit and loss report, because we have an income tax system. The profit and loss report is the report that's going to help you, mainly the report that helps you to generate your Schedule C if you're a sole proprietorship, or your other tax returns if you're a partnership or a corporation. Although in some cases, if you're larger, you might need the balance sheet as well. Now, we still want the balance sheet in QuickBooks because the balance sheet, it forces us to do the double entry accounting system. The double entry accounting system gives us much higher level of certainty that we have recorded things accurately. And so that means that our income statement is much more likely to be accurate if you enter the data into software that forces you to use the double entry accounting system, which will force you to create a balance sheet as well. Okay, so then, but so the statement of cash flows isn't typically something that we're going to use to do the tax return. So it's going to be something for reporting purposes that might be an added value giving us the cash flow, which of course is important because the cash flow is the lifeblood of the company. So now that we have our performance statement, income statement, not on a cash flow basis, then we might want to add the cash flow basis because, again, the cash flow is the lifeblood of the company. All right, so here's going to be the statement of cash flows. Let's close it up and then open it up one by one. So I'm going to close up the three sections here and we'll just analyze it. So let's do this. This is only 1 month. Let's do it for the year here. 0101, let's say 24 to 12/31/24. Run it. All right, now I got to close it up again. So now we have the 3 sections. All right, so here are what is the statement of cash flows? Well, you can, from the most simple standpoint, you can kind of think of it like an income statement, a performance statement. It needs a beginning and an ending date. It's not reporting as of a point in time on a cash basis instead of an accrual basis. And so that's going to be the general idea, although that mainly is tying out to the operating activities. But we also have investing activities and financing activities. So the 3 activities that could be on the statement of cash flows: operating, investing, and financing. So quick overview on what's going to be in those 3. The operating activities you could basically think of as the income statement, which has been converted or reconciled to a cash-based system as opposed to an accrual-based system. We'll get into more detail on that shortly, but that's going to be the major section. That's the big one, of course, because most of the cash flows are for operations, which on an accrual basis are income and expenses, right? And now we're going to do that kind of on a cash basis, or at least reconcile to that. Now, there's 2 methods to use to do that, a direct and an indirect method that we'll touch in on shortly. But then we have the investing activities. Now, this one always used to confuse me when I was learning like just accounting from a textbook, because I have the idea that investments are basically me taking my money and investing it in stocks and bonds, which from a finance perspective is usually what we mean by an investment. But we can also use the term investment more broadly, meaning that in essence, every asset that we have in the business is an investment. Even cash in the business is kind of an investment, because the idea is if you have the cash in your business as opposed to into your personal checking account, it's there for a reason. You invested it in the business because you're going to use it at some future point, most likely to buy property, plant, and equipment or something like that, or pay for expenses. But the main things that we have on assets in our balance sheet, in other words, if I go to my balance sheet here, what is the balance sheet consisting of? Mainly, we're not going to sit here and hold on to cash. There's no reason to hold on to cash, because if I had excess cash, I would give it to the owners in the form of a draw or a dividend so they can invest it themselves. It wouldn't need to be in the business. What I'm usually buying in the business is property, plant, and equipment, the things we need in order to help us to generate the income. And that then is the major thing we think of as an investment. So we think about it here as fixed assets, but if it's something that the business bought and they didn't consume it, we didn't expense it because we didn't consume it yet, but are putting it on the books as an asset that we're going to consume later, that is the definition of an investment. So the property, plant, and equipment are going to be the main things that are over here on the investment activities. And you can kind of think about a transaction and think about whether or not it's going to be in operating, investing, or financing by thinking, is there an income statement component to the transaction? And if there's not an income statement component, then most likely it will not be in operating, but will be either in investing or financing. So that means investing usually deals with the purchase of property, plant, and equipment, and the selling of property, plant, and equipment. And then we've got the financing activities, which is typically when we think about how do we buy the property, plants, and equipment, how do we get the money to buy the property, plants, and equipment? Well, we could have earned it and taken it out of like equity, but we also might finance it, for example, taking a loan to finance. So those are going to be the things in the finance activities. Either the loan activities, we took out a loan or we paid off the loan, or financing through equity. The owner put money into the business, which if it was a sole proprietorship would be just an investment, owner investment, or a partnership. If it was a corporation, it would be the selling or of the distribution of stocks. We would create more stocks. All right, so that said, let's look at each of these categories. So we've got the operating activities. Now, the other thing to realize here is if you're going to say, okay, well then the operating activities is basically like the income statement on a cash basis instead of an accrual basis. So you would think what you would do then is look at the income statement line by line, income, expenses, and convert them from a cash basis to an accrual basis, right? So I'll just recreate the income statement on a cash basis. That would mean that instead of recording income here, for example, when we earned it, which might be at the point that we entered the invoice, we don't record income until we actually received it, until cash was received. So, and you can kind of get an idea of that by switching to a cash basis up here. So if I switch to a cash basis, what's QuickBooks going to do? What it should do basically is create the income statement, but instead of entering the accrual components, recording revenue when a non-cash transaction happened, such as an invoice or a bill, and then only record transactions when cash is impacted, meaning income goes up when we have a cash register sale, which would be the same under an accrual or cash system, or instead of recording when an invoice is created, recorded when we have the received payment. Recording expenses when a check went out, for example, or an expense payment, but that would be the same under a cash or accrual, and not recording an expense when accounts payable happened, but rather recording it when we pay off the accounts payable, right? That would be here. So this switch from accrual to cash is basically giving you kind of an income statement on a direct, what we might call a direct method cash flow statement. So the bottom line down here, let's just check out, comes out to 698.73. Over here, it came out, so it's not exactly what it came out to here on the statement of cash flows, but that's the general idea. But the statement of cash flow usually uses what we call an indirect method. So what is an indirect method? Well, that means we're going to start with net income, which was 2088. Let me go back on over here and say, let's go back to accrual. Well, let me before I do that, let's bring this to 2024 and run it just to check it out. Was that 698? Okay, 698, and over here we're at, okay, that's not the same. Let's check it out. Let's make it go to accrual again and run it for 2024. So now we're at the 208838. So that's going to be our starting point, 208838. So you can see how on an accrual basis, the income statement will tie into the statement of cash flows because the net income will tie in. And then we're going to back out all of the things that are accrual. How do we do that? Well, we go to the balance sheet accounts that are accrual accounts, meaning accounts receivable is an accrual account. And we basically look at the difference or change in accounts receivable and back out the accrual component. Same with accounts payable, the credit card, and so on and so forth. Now, I'm not going to get into how do you do that in detail, but if you can do that, if you understand that well, then you really have a good understanding of the double entry accounting system. We have other courses and sections on that. If you want to do that, it's a really good exercise. I mean, if you could build a statement of cash flows, I have a good amount of experience with that because when I worked at CPA firms, we had to build the statement of cash flows, and like a lot of people didn't like doing it because they didn't really have a system to figure it out. So I got kind of dumped with that as a newer person, but then I got good at it, and I kind of enjoyed doing it to some degree. And if you understand it, then again, it's a really good practice to just understand the double entry accounting system. But that's the general idea is we're going to start with income and then back it out to cash flow on the income statement from a cash-based system. Now, why is the indirect method the one that's primarily used instead of the direct method where you would start with income minus expenses on a cash basis in essence? And the reason is because this gives you an added reconciliation. See, if I just started and made an income statement that was on a cash-based system, what would happen is that would be great, but I'm not really seeing the difference between the two. Whereas this gives me a reconciliation, kind of like a bank reconciliation, which says, hey, this is what the bank says is cash at the same point in time. This is what our books say is cash, and here's exactly what the difference is. That's what this is doing here, right? This is the net income that we say on an accrual basis. These are the differentiating factors that reconcile it to, in essence, net income, or the total adjustments to cash on a cash-based system. All right, that's the general idea. But then we have the investing activities. Now remember, the investing activities are the things like where cash is impacted, but there's not but it doesn't affect the income statement. So for example, if I buy a truck for cash, then cash is affected, but the transaction to record that would be to increase the asset account and then decrease cash. No income statement account was impacted. So it needs to be on the statement of cash flows because cash was impacted. There was a cash outflow, but because on the accrual system, we didn't put it on the income statement, I'm not going to put it in the operating activities. We're going to put it down here into the investing activities. Similarly, if we sold the truck, then we would have an increase in cash possibly. But once again, I'm not going to put it on the operating activities, but on the income statement. Okay, so then we have the financing activities where similarly we have a cash impact because the owner put money into the business, or we sold stock, right? We issued stock. In those cases, we would have an increase in equity, but the other side wouldn't be going to income or anything, right? It would be cash goes up, equity goes up, no income statement. Or we gave money to the owner in the format of a draw for a partnership or sole proprietorship, or a dividend for a corporation, in which case cash went out, but it wasn't for an expense. It didn't hit the income statement. The other side is on the equity section. Therefore, those are financing activities. And so if we look at the cash flows from operating activities, investing activities, and financing activities, we get then to the change in cash, and then finally to the cash at the end of the period. So then the change in cash, and then we're going to add the beginning cash, and that gives us the cash at the end of the period, which is the same in this case because there was only activity for the one period here. So that means that the bottom line of the state, so there's two tie-outs that we can see in the statement of cash flows. The net income should tie out to the bottom line of the net income on the income statement, and the bottom line of the statement of cash flows should tie out to what's on the balance sheet, which is often a little bit more confusing, in part because of that unearned revenue or undeposited funds, if that's a factor. So let me show you. If I go to the balance sheet as of the end of 2024 and we pull out the trusty calculator, we're going to say, all right, let's check this out. We've got the checking accounts. That's the 3958.61, but we also have this amount in undeposited funds. I have to include that because that's cash in essence, but we couldn't put it up here into the account types of the checking accounts because they don't have the special functionality of having connection to the bank feeds. So you see why now normally, hopefully, undeposited funds will be zero because we will have zeroed it out. But notice the functionality problem in QuickBooks. In QuickBooks up here, normally for external reporting, we would call this cash and cash equivalents. But for QuickBooks, it wants to call it bank accounts so that these accounts have the special categorization functionality-wise of connecting to the bank feeds. And this account, although it should be in cash and cash equivalents under normal reporting standards, is now in this other category because it doesn't have that added functionality of connecting to the bank feeds. So if that's there, we have to add that in. So this would be 687.15 is the bottom line, which if I go back over here, now that comes out to the 464576. All right. So I just want to point out also that QuickBooks generates this report and it will always tie out, which is nice, but it's not always going to be perfect. So if you were to do formal external reporting for generally accepted accounting principles, then this might be a good starting point, but you probably would have to do at least a little formatting and possibly some more adjustments to some transactions. Why? Because, for example, if you sell investments and there's a loan component or a trade-in or something like that, then there might be a more complexity in the transaction that's not being caught by the way QuickBooks is doing this. So if you sell property, plant, and equipment and there's depreciation involved, it might be a little bit more complex that it's not going to record it exactly the way it should be. Or if you sell property, plant, and equipment and there was a trade-in involved, or you bought property, plant, and equipment, but you didn't just pay cash for it. You bought property, plant, and equipment, put a down payment on it, and took out a loan. That transaction might be a little too complex for QuickBooks to record properly. It'll record it in a way that's still in balance typically, but it won't be exactly right oftentimes. Also, you've got some formatting issues here. And that is usually the statement of cash flows has these directionality in the titles. So like usually it says operating activities, and then it says down here, net cash provided by operating activities. Notice what it says provided by. That should mean an increase, you would think, in the cash. But what happened here is there was a decrease. So like this was always a pain for me because I was never really great at I got the numbers right on the formatting of the statement of cash flows, but I was never really great at the text, right? And then someone would, well, you can't put, it shouldn't be provided by, it should be used in, right? So the text should technically be changed to be, this is the decrease. And then similarly, notice this accounts receivable, all these accounts should normally, they should say it was either an increase or, a change, an increase or a decrease, right? In the term. So that would often be the case. Similarly, down here it says net cash provided by, but it's a decrease. So it wasn't cash provided by, it was used in or something, right? And so those are just some terminology. And then cash this would be net cash increase for the period, which happened to be an increase. But what if cash decreased during the period? Would it change the language? I don't think it would in QuickBooks. It's just going to always keep that name. But it's not. It wouldn't be an increase. That it would be a decrease. So, that's kind of like I always think of that as like kind of like I'm not really as worried about it as long as the numbers are directionality going the right way. But technically the words are wrong and it's not as professional and the words are going the wrong way. And then so that's going to be the general idea. But that's the general idea with the statement of cash flows. Obviously, it's another report that we possibly would want to package together when we do our reporting packages that we might give to a client at the end of the month, quarter, and or year.